Every week, most people casually spend $12 without thinking twice. And that habit quietly shapes their entire financial future. I am Alex, and today I want to show you why that small weekly amount matters far more than most people realize. Before we begin, if you enjoy clear, stress-free money ideas, gently tap like, share this video, and subscribe for future updates. I promise everything here is explained simply, without complicated jargon, trading stress, or assumptions that you already understand finance. Think about coffee runs, quick snacks, delivery fees, or small subscriptions that quietly drain a few dollars every single week. Most people forget those expenses by tomorrow, yet they repeat them for years without ever questioning the long-term cost. I used to believe $12 was too small to matter, especially compared to rent, bills, and other obvious monthly expenses. But once I stopped looking at money weekly and started looking at it over decades, everything completely changed. What if that same $12 did not disappear, but instead quietly worked for you every single week? Not through risky trading, gambling, or guessing markets, but through a slow, predictable system designed to reward patience. If you have ever thought you do not earn enough to invest, this video was made specifically for you. You do not need a high salary, special skills, or perfect timing. Just consistency and a basic understanding of how money grows. Over the next few minutes, I will walk you through a system built on dividends, compounding, and disciplined reinvestment. This approach does not promise overnight riches, but it quietly builds income while most people remain distracted. By the end, you will clearly see what $12 a week can realistically become over time. Doins. If that idea sparks curiosity, comment 12 below, so I know you are following along seriously. Now let us take one step back, because everything in this strategy begins with a simple concept called dividends. A dividend is a portion of a company's profit that gets paid directly to people who own its stock. When you own dividend-paying shares, you are not just hoping prices rise, you are collecting income along the way. That income arrives regularly, even when markets feel boring, flat, or emotionally uncomfortable for most investors. Many strong established companies share profits because they generate steady cash and expect to remain profitable long-term. These payments usually arrive quarterly, sometimes monthly, creating a predictable rhythm that slowly builds financial confidence. The key difference is this income pays you without forcing you to sell your investment or constantly watch prices. Your shares remain intact, working quietly in the background while dividends show up whether markets feel exciting or boring. Some companies even increase those payments over time as profits grow, which means your income can rise without extra effort. This upward trend is called dividend growth, and it plays a massive role in building long-term passive income. At first, dividend payments may feel small, almost insignificant, especially when you are starting with limited money. That is exactly why most people ignore them and chase faster, riskier strategies that feel more exciting. But the real power appears when dividends are combined with patience and a decision most investors overlook. When dividends arrive, you face a choice that quietly determines how fast your future income grows. You can take those dividends as cash and spend them, or you can reinvest them to buy more shares. Reinvesting dividends is commonly called a dividend reinvestment plan, or simply DRIP. With DRIP, your dividends automatically purchase additional shares instead of sitting idle inside your account. This creates a feedback loop where your investment steadily grows without requiring additional money from your paycheck. Let me illustrate this with an example that keeps things simple and easy to visualize. Imagine investing $1,000 into a stock that pays a steady 5% dividend annually. Without reinvesting, you would receive $50 per year while your original investment stays unchanged. After several years, you collect income, but the engine itself never becomes stronger or faster. Now compare that with reinvesting those dividends back into the same investment automatically. Each payment buys more shares, which then generate even more dividends the following year. Over time, that growing share count steadily increases both your income and ownership without requiring any additional effort. This self-reinforcing cycle is what investors call compounding, and it proves far more powerful than it initially appears. Compounding feels boring early on because results remain small, quiet, and extremely easy to dismiss or underestimate initially. But given enough time, those small reinvestments begin stacking on top of each other relentlessly year after year. Think of it like planting seeds that grow into trees, which later drop seeds of their own eventually. Eventually, a single seed becomes a forest that keeps expanding over decades without demanding your constant attention daily. The longer you allow compounding to work uninterrupted over time, the faster your financial progress accelerates consistently forward. This is why time matters far more than intensity when building sustainable, stress-free investment income streams long-term. Unfortunately, many investors unknowingly sabotage this process by making a few common and extremely costly mistakes over time. The first mistake is chasing extremely high dividend yields simply because they look exciting on the surface initially. Curd. When a yield appears unusually high, it often signals underlying business trouble or unsustainable dividend payouts ahead eventually. In those cases, dividends frequently get cut, and share prices fall sharply at the same time unexpectedly together. This dangerous combination reduces your income while also shrinking your investment value much faster than expected over time. Investors call this situation a dividend trap, and it quietly destroys long-term progress for years without warning. Another commonly overlooked mistake is ignoring something called the payout ratio entirely when evaluating dividend stocks long-term. IUTA. The payout ratio measures how much of a company's profit is used to pay dividends to shareholders annually. Healthy companies balance rewarding shareholders while retaining enough earnings to support future growth and stability during uncertain markets. When that balance disappears, dividends become fragile and far more vulnerable during periods of economic stress, unexpected downturns. Understanding these warning signs helps you avoid emotional decisions and better protects your long-term income stream consistently. Just as important as avoiding bad picks is spreading your investments across different industries and sectors over time. Relying on a single stock or sector exposes your income to unnecessary risk during unexpected downturns market cycles. Diversification spreads that risk, smoothing income when one industry struggles while another continues performing steadily over long investment horizons. This balance helps your portfolio remain resilient, even when headlines feel alarming or markets temporarily decline for patient investors. Now that the foundation is clear, let me explain how I personally approach selecting dividend investments for long-term income. I never search for the highest yield, because sustainability matters far more than impressive numbers on paper over time. Instead, I focus on companies with consistent profits, manageable debt, and a proven history of dividend growth records. Dividend growth shows a company is confident enough to raise payments as its business continues expanding year after year. That growth acts like a silent pay raise, increasing your income without demanding extra effort from your busy schedule. Financial strength also matters, so I look for steady cash flow and businesses that survive tough economic periods. Strong balance sheets give companies flexibility to protect dividends when revenue temporarily slows or costs rise unexpectedly during downturns. I also avoid concentrating everything in one sector, because no industry leads forever without setbacks or periods of decline. Diversifying across sectors creates smoother results and helps me sleep better during volatile markets without constant monitoring stress. Finally, I think beyond dividends and consider total return, combining income with long-term price appreciation for balanced growth. Some companies pay modest dividends but grow fast enough to outperform higher-yielding alternatives over time for patient investors. This combination of income and growth is what quietly builds wealth without constant decision-making or emotional market reactions. Now let us apply these principles to a simple example, using a realistic $12 weekly habit consistently. $12 per week equals $624 invested each year without feeling financially overwhelming initially. On its own, that amount seems small, which is exactly why most people dismiss it immediately without deeper consideration. But when invested consistently into dividend assets with reinvestment, time begins doing the heavy lifting for disciplined long-term investors. Let me walk you through what this small habit can realistically become over several decades using updated market assumptions. Assume a diversified dividend portfolio using recent long-term market averages supported by updated data from reliable financial research sources. With $12 invested weekly, your first-year contribution totals $624, forming the initial foundation. During early years, growth appears slow, and results feel almost invisible, which causes many people to quit prematurely. After 5 consistent years, that small habit can realistically grow into several $1,000s, even without aggressive assumptions. At this stage, dividends remain modest, but reinvestment quietly increases your share count behind the scenes steadily. Tepao. By year 10, compounding becomes noticeable as your portfolio value and annual dividend income begin accelerating together. This is where patience starts paying emotional dividends, because progress finally feels tangible and motivating. By year 20, your contributions matter less than your accumulated capital working continuously on your behalf. At this point, dividend payments alone often exceed what you personally invested each year from your own pocket. The portfolio effectively starts funding itself, reducing reliance on future contributions while momentum continues building. Duisto. This shift represents the moment many investors describe as money working harder than they do daily. Extending the timeline to 30 years reveals the true potential of consistency combined with disciplined dividend reinvestment. Under reasonable assumptions, the portfolio can grow into several $100,000 without extreme risk-taking. At that level, annual dividend income alone can reach tens of thousands of dollars consistently. Broken down monthly, that income approaches the level of a second paycheck, arriving without active labor. All of this originates from a habit most people casually waste on convenience purchases each week. The difference is not intelligence, timing, or luck, but commitment to a simple, repeatable system. Small decisions repeated consistently over long periods outperform dramatic decisions made only once occasionally. This is why I focus less on market predictions and more on building habits I can sustain indefinitely. Now that you see the math clearly, let us reflect on why most people never reach this stage. DREI. Most people never reach this stage because they underestimate time and overestimate short-term excitement, repeatedly driven behaviors today. They search for fast wins, shortcuts, or perfect moments, abandoning systems that require patience and consistency over years. Wealth rarely rewards urgency, but it consistently rewards people willing to stay disciplined longer than others over time. This explains why simple strategies often outperform complex approaches, demanding constant attention and emotional decision-making from investors. When a system feels boring, predictable, and uneventful, it is often working exactly as intended over long periods. Consistency removes pressure to guess markets, predict news, or react emotionally to daily price movements calmly over time. Instead of stressing over volatility, you repeat a habit steadily building ownership and reliable income over many years. This mindset shift separates long-term builders from people who endlessly restart after setbacks and distractions arise frequently. Another reason people fail is waiting for perfect conditions that realistically never arrive during markets, economies, and lives. There will always be uncertainty, headlines, and reasons to delay starting regardless of market conditions today or tomorrow. Successful investors accept uncertainty and move forward anyway, using small, controlled, repeatable actions consistently over long horizons patiently. $12 a week reduces fear because the amount feels manageable during uncertain financial periods for most people. Starting small builds confidence, which later supports larger decisions without overwhelming emotional pressure or regret long-term growth. Over time, this confidence compounds alongside money, reinforcing discipline and long-term commitment naturally through habits, routines, systems. Eventually, investing becomes routine, not stressful, and stops competing with other life priorities daily, weekly, monthly decisions consistently. Kaoryu. This is when the system becomes sustainable and integrates seamlessly into normal weekly habits for long-term success. At this stage, missing a week feels worse than investing, signaling a powerful behavioral shift toward ownership, discipline, consistency. Now let us revisit why dividends play an important psychological role in maintaining motivation during long journeys ahead. Receiving regular income provides positive reinforcement, reminding you progress continues even quietly during flat markets and waiting periods. That steady feedback loop keeps you invested mentally, not just financially, through long, quiet stretches of time patiently. Dividends provide tangible proof that your system works, delivering income even when market prices move sideways over long periods. That income reduces anxiety, builds trust, and encourages you to stay invested during uncomfortable or boring market environments. Seeing cash arrive reinforces patience, making it easier to ignore noise and focus on long-term ownership goals consistently. This psychological benefit is why dividend strategies often outperform purely growth-focused approaches for everyday investors over long periods of time. Now let us examine updated assumptions using recent historical averages from reputable United States market research institutions, published data, sources. Over the past decade, diversified dividend portfolios delivered competitive returns while reducing volatility compared to broader indexes for long-term investors. According to recent data, long-term dividend growth has meaningfully contributed to total returns across multiple market cycles historically. Reinvesting dividends consistently amplifies this effect, especially when contributions continue weekly without interruption over many years and decades. This is why I emphasize systems that function regardless of headlines, emotions, or temporary market stress events, cycles, and sentiment. Let us return to the $12 habit and project realistic outcomes using conservative assumptions over long investment horizons. With steady contributions, dividend reinvestment, and time, the portfolio gradually reaches meaningful scale for long-term income goals. At that point, income growth accelerates because dividends are generated from a much larger base of invested capital over time. What once felt insignificant becomes powerful, simply because consistency allowed mathematics to work uninterrupted over long periods of time. This transformation surprises people because nothing dramatic happened, yet results quietly compounded over many years, decades, without attention-grabbing moments. Importantly, this approach avoids constant decisions, reducing mistakes driven by fear or greed during volatile market environments, periods. Less activity often leads to better outcomes, especially for investors balancing careers, families, and busy lives over long periods of time. Now consider how many years most people delay starting, believing they will begin later when circumstances improve, magically. Those lost years permanently reduce compounding potential, which no amount of future effort can fully recover once time passes by. This reality makes starting small today far more valuable than waiting for perfect conditions that never truly arrive. With that perspective, let us prepare to close by summarizing the core lessons clearly for long-term success. Let me clearly summarize everything in this system, so you can understand exactly how consistent habits create long-term wealth. First, small amounts matter only when invested consistently, instead of being spent mindlessly on coffee, snacks, or other weekly conveniences. Second, dividends transform simple ownership into real income, paying you reliably without requiring you to sell any shares prematurely. Third, reinvesting dividends accelerates growth automatically by purchasing more shares, creating compounding over long periods without additional effort. Fourth, avoiding common mistakes protects progress more effectively than chasing high yields or exciting but risky short-term opportunities. Finally, time is the most powerful ingredient, and starting earlier always produces better results than trying harder with larger sums later. None of these principles require advanced knowledge, a high income, or constantly watching the market to succeed consistently over decades. They require discipline, patience, and repeating a simple habit even when results feel invisible, slow, or discouraging at first. Most people never reach financial independence not because it's impossible, but because they quit too early, losing the power of compounding. They underestimate what consistent effort achieves over decades and overestimate the impact of occasional dramatic decisions or short bursts of work. The $12 weekly habit removes complexity, stress, and excuses, making investing accessible to nearly anyone regardless of background. It turns investing from an intimidating, high-pressure event into a manageable routine integrated naturally into your everyday life effortlessly. Over time, this routine builds confidence, ownership, and passive income quietly, without demanding constant attention or emotional energy from you daily. Eventually, your portfolio reaches a stage where dividends alone meaningfully supplement, or in some cases replace, portions of your earned income reliably. At that stage, financial pressure diminishes, choices expand, and you gain flexibility to focus time and energy on other life priorities comfortably. Your B. Achieving this outcome does not require perfection. Only consistent discipline sustained longer than most people are willing to maintain over decades. If you remember nothing else from this video, remember that this system rewards patience far more reliably than intelligence or prediction skills ever could. Small, repeated actions shape results far larger than dramatic decisions made once or twice, emphasizing consistency over intensity in investing. The real question is not whether this system works, but whether you will allow yourself enough time to let it fully succeed. With that understanding, let us move into the final thoughts, closing message, and key lessons you should carry forward today. Before we close, I want to remind you that small weekly habits become surprisingly powerful when repeated over decades consistently. Every $12 invested today quietly grows into ownership and income, compounding silently while most people remain distracted and unaware. Starting small makes the process manageable, reduces stress, and builds the confidence necessary to maintain the system over long periods. Patience is critical because meaningful results do not appear immediately and require time to accumulate and manifest noticeably in your portfolio. Dividends are the backbone, providing a reliable feedback loop that confirms progress, motivating you to continue even during slow periods. Reinvesting those dividends accelerates growth automatically, buying more shares that themselves generate income and compound again over the following years. Consistency compounds not only wealth, but confidence, turning small actions into meaningful results far more effectively than sporadic larger investments. Avoiding common mistakes is just as important as investing consistently, protecting your capital from traps that quietly erode progress over time. High yields, concentrated positions, ignoring payout ratios, and neglecting taxes are common pitfalls that can silently undermine long-term plans. Diversifying across industries and asset types smooths returns and reduces risk, allowing your portfolio to grow more reliably through market cycles. Combining a healthy yield, consistent dividend growth, financial strength, and proper diversification creates a portfolio designed to last for decades. This approach allows even small contributions, like $12 a week, to eventually produce significant monthly income without extra stress or effort. Remember, results feel slow at first, but over 10, 20, or 30 years, compounding turns tiny contributions into substantial financial resources. The difference between quitting early and maintaining discipline is enormous, often determining whether your portfolio reaches hundreds of thousands or stagnates. This strategy is simple, but requires commitment. Following it faithfully allows time and mathematics to do the heavy lifting for you consistently. Shoot. Many people fail not due to inability, but because they underestimate time, overestimate short-term results, and abandon habits prematurely. Accepting uncertainty and committing to a small, repeatable system empowers you to progress steadily without worrying about market noise or daily fluctuations. The $12 habit demonstrates how accessible financial growth is when properly structured, removing excuses and making investing easy to maintain. Over decades, this same habit can generate thousands of dollars monthly, creating a second income entirely passive, built without stressful trading. As we approach the final summary, keep in mind that the power lies not in size of contribution, but in time, discipline, and consistency. Finally, remember that patience, consistent habits, and reinvested dividends turn seemingly small weekly contributions into extraordinary long-term results. Even $12 a week compounds silently over decades, eventually generating significant passive income while you focus on other priorities. Consistent investing builds not only money, but confidence, teaching discipline and reinforcing positive behaviors that benefit your entire financial life. Avoiding common mistakes ensures that progress continues uninterrupted, preventing traps that silently reduce your portfolio's long-term potential. Diversification across industries and strong companies balances risk, allowing your portfolio to remain resilient through market cycles and economic challenges. TOREIT, the combination of a healthy dividend yield, consistent growth, financial strength, and time, creates wealth quietly without constant stress or fear. By committing to a small, repeatable habit, you allow compounding to work effectively, turning tiny weekly contributions into substantial long-term income. This strategy emphasizes discipline and time over luck or intelligence, proving that anyone can benefit if they follow it consistently. Your financial freedom is determined by choices repeated over years, not dramatic single decisions or attempting to time markets perfectly. Now that you understand the full process, it's time to start today. Invest consistently and let your $12 a week work for you.